What is up, guys? My name is Aaron Letty. Thank you guys for tuning in and watching this, whether it's recorded, whether it's live. I appreciate you guys hopping in today. I am the head of fulfillment over here at Results Driven REI. I oversee our small group community and everything as far as education. Um, Today, I brought in a special guest. I get the most common question. We're all in the entrepreneurial space. The most common thing I get all the time is things around, who's managing my books? What kind of questions am I getting as far as, taxes? So things like that. So I know commonly we have a lot of resources. There's a lot of things out there, but I wanted to bring in, somebody that's, renowned within, the organization and honestly the real estate space. So I wanted to bring up Matt, who's a managing partner over at Truebooks. Matt, can you hear me?
Yes, I can. Oh,
What's
I
going
look
on, man?
pretty
How are you?
zoomed in. All right.
Good,
I'm
man.
good.
So I want to set the stage for you and kind of kick it off, man, and kind of give the rundown of maybe some of your background. I know you have a pretty intensive background. Looking at some things that we were talking about earlier, and give a rundown of what your services look like, what you guys offer, and how you guys can help out. Our community and a lot of people that are out there that are watching this video and this recording.
Yeah, for sure. Thanks, man. So today I'll cover just a range of topics that I find to be most prominent that come up as I talk to investors and take on more clients here at the firm. So I hope to hit on most of the major topics today. Again, if anybody has any questions while I'm presenting, feel free to stop it. I don't want this to sound like a lecture. But other than that, yeah. So I'm the managing partner of Truebooks. We started Truebooks in 2020. My business partner Ryan Pineda and I, and it really stemmed from I first landed him as a client, was helping him with his bookkeeping and his tax work. And then, as you guys probably know, there's such a big need in the real estate space for, it sounds kind of brass, but just somebody that knows what they're doing as far as the accounting and tax goes. So we felt that we would fit that need. And since then, it's really taken off. So our core competency is real estate. And with respect to tax preparation, just filing the tax returns and preparing them, tax planning, which is where all of the money's saved, and then actually in the accounting and bookkeeping side of it. So really those core three services are what we focus on here at the firm. So yeah. And then, like I said, today, I hope to bring some value as far as what the biggest tax topics and strategies are, and just some overarching things that I find to be most relevant. So.
Perfect, man. Yeah, so let's go ahead and let's dive right in. Great introduction. I know once again you work close with Pineda, and all those guys are at Future Flipper. So we got a lot of you guys in the community. So love the program, love the partnership. So yeah, man, let's dive into some common things. I get questions that are honestly over my head all the time, so I got to reference them to the CPA pros like yourself, man. So
yeah, do you want me to share screen or I can just read it off? It's up to you. I put together a slide deck. Usually I don't use slide decks, and I'll just more of do like Excel or talk off like the bullet points, but I can share the deck or I can just talk about it. It's up to you.
Yeah, I think sharing the deck would be cool. Preferable.
Does it allow me to share screen here?
Do you have to? One second. Aiden's grabbing it right now.
Hold on. I should be able to share screen.
Go ahead and click share at the bottom. There should be like a little.
Yep. Can you guys see that?
Yep.
Cool. All right. So here's sort of a deck. So if anybody has any questions or something like that, wants to stop me, or if you find that I need to go further into like in depth on something, feel free to stop me there too. So, all right. So this is going to be really real estate focused. And so as far as all these strategies go, and again, these are the sort of the hardest hitting, the most relevant things that we talk about as we get new clients and as I do presentations and meet new investors and even seasoned investors. So the first thing that I wanted to go over are the benefits of an S corporation and why and when they make sense. So overall, most people will start out in business and have an LLC, which is going to give you that limited liability company protection, right? What you sought out for, which is separating the liability from the entity itself and you doing business, right? You personally. So you're still going to have that when you have an S corporation. A lot of people get confused and say, hey, I don't have an LLC, I have an S corporation. They're really one and the same. Think of an S corporation as you're just telling the IRS that you want to treat your current LLC as an S corporation. It's more of like a hat or designation that you're wearing. And so the major tax benefit here, I don't know if you can see my mouse. Yes, is lowering self-employment tax. And I have a quick example here of somebody in the most common case of how they'll save money here with this. Let's say you go out and set up an LLC and start to do business, whether you're flipping, wholesaling, whatever the case is. Let's say you make $100,000 of income, you have $20,000 of expenses, you net $80,000. You're going to pay 15% in self-employment tax. And that's because when you're self-employed, you have to pay the entire 15%, 7.5% for the employee, 7.5% for the employer. You're both, right? You're both the employee and the employer. It's not like when you're at a W-2 job and you have portion withheld from your paycheck and then the company pays the other portion. You pay both. So in this case, you could say just with self-employment tax, you'll pay about $12,000 and then you'll take home $68,000. The same exact scenario now, but with somebody who elects to be treated as an S corporation. Let's say they have $100,000 in income, they have $20,000 of expense. So same scenario, you're both going to bring home $80,000. But in this case, you have $40,000 paid to you as a W-2 from your own business to yourself as the employee. And so the kicker here is you're only going to pay 15% on the $40,000 that you pay yourself, not the entire net income. So you can see here in this case, you just slashed it in half and only paid $6,000 in self-employment tax just by having that S corporation set up. It's free to get an S corporation. And what I mean by that is it's just another tax form that you have to file. So if your accountant charges you a fee for that, usually it's pretty nominal. It's included in our tax planning. So just gives you a baseline there. If you try to go somewhere and they sell you on $4,000 to get an S corp, that sounds a little overboard and I'm not sure what they're really offering you. So, but in this case though, you could see where there was savings of about $6,000 just in this example. The two things that I want you to keep in mind if you do this is when you set up an S corporation, you have to issue yourself payroll if you work within the business, which it's very much likely that you do. That would be the reason that you're setting it up. So you have to, one, pay yourself a wage through payroll. So you have to set up a payroll service. We recommend our clients use ADP. You can go anywhere you want though. So don't let somebody strong arm you into something. You can use Gusto, QuickBooks, ADP, wherever you want. Two is, so not only do you have to pay yourself payroll, but you have to file another tax return. And that typically for us would start at about $1,000 to $1,200. So you can see there are some additional costs there from running the S Corp model. And that's why we say the break even is about $50,000. Once your business starts to net 50,000, not gross, net 50,000, it's very likely that it's going to make sense for you to convert to that S corporation. So before I move on, any questions there? Anything else I should touch on really quick? Sorry for the raspiness. I think my kids gave me something. I got young kids
around right now. So I guess the number one question that I would have, speaking on behalf of a big group of people, we run across people that are one-man shows, big teams, massive operations. I guess would you say that the S corp route is the best way to go for everyone, or would you say that there's a certain revenue threshold that you need to hit before you get to going from an LLC to an S corp?
So net income wise, you're going to want to, at 50,000 net income is likely when you're going to want to run as an S corporation, whether you have employees or contractors. Cause I know a lot of people when they're starting out, they just pay people as contractors and that's totally fine. That shouldn't deter you from setting up an S corp. So the benchmark that I would be watching for myself is, am I netting at least 50 grand? If you're about to, and even if you're going to net at least 50 grand and we're already in August, it's smart for you to have that conversation with your advisor. So the net income of 50 grand is really that benchmark of where it makes sense.
That was really the only question that I could think of around S corp. It's good.
Cool. All right. Yeah. So we'll jump to the next one. So quick tip while we're on the S corporations is, I know a lot of people that are doing deals, whether through wholesale or flipping, it's very easy because you have the banking relationships already in that entity. That's where your lenders are dealing with, that if you find a property that you want to keep as a rental, it's quick to just fire on it within that S corporation. And I can't advise you strong enough to try and avoid that. Do not buy rentals in your S corporation. Tax wise, it's really going to hurt you. And the biggest reason here is this gain if you transfer it out. And the reason it hurts real estate investors, like whether you're an investor or a flipper or a wholesaler, it's going to hurt you the worst is because you're buying deals at a discount. So quick example, let's say you find a deal with the fair market value of 100 grand and you lock it up at 80. If you lock it up at 80 and then realize this is a deal that you want to keep as a rental, and let's say you want to transfer it out of your S corporation, that's a taxable event, just moving it out. And the gain is calculated on the fair market value minus your cost. So again, if you bought that deal at 80 and it's worth 100 and you move it out, you just created a $20,000 taxable gain to yourself. And so that's where you really lose flexibility when you put properties inside of an S corporation. The only properties you should own in an S corp is if you're a flipper and you're sitting on these properties to rehab and sell. So always keep in mind that try and avoid putting any rentals or buying a rental in your S corp. If you can evaluate the deal up front and recognize that you're going to keep it as a rental, try and buy it in a separate LLC off to the side, which we'll go over later as far as an entity structure and what that looks like. But try your best to avoid buying it within the S corp. So anything there? No?
Nope, no questions there.
All right, quick note on flipping. The biggest holdup that we find with flippers that come to us that whether want tax planning or accounting is they don't keep a balance sheet. And really what this is, right, there's two core financial statements for businesses. You have a balance sheet and a profit and loss. Profit and loss are your income and expenses. A balance sheet is showing you your assets, your liabilities, and then, right, like essentially your net worth, your equity. A lot of people get tripped up and think that, let's say you buy two properties and then let's say you buy a property for 300 grand, you put $100,000 into it, you're all in for 400,000 and you don't sell it as of year end. None of those costs are expensed. They all sit on your balance sheet as inventory if you're a flipper. When you write that property off is when you sell it. So let's say in year one, you've put all this money into the property and then in year two, you've sold it. That's when you write off the cost of that property and recognize your revenue of that property. So again, most of the time we find this on the accounting side, that when we have clients come to us that need help with their bookkeeping, the first place I look is their balance sheet. Because if I look at somebody's balance sheet for the end of the year and they're like, oh, I had about 10 properties on hand, I sold a few. The first thing, if they tell me they have 10 properties on hand, I'm going to go to their balance sheet and I'm going to look at their inventory. And if they don't have a couple million in costs there, I assume that something's wrong. Because again, all of the properties and the costs that you've accumulated for properties that you have not sold yet, they need to go to the balance sheet. So any questions there? I know this one can be tricky, but this is where honestly that if you're a flipper, I just always recommend that you find an accountant that knows exactly how to handle your books. It gets very tough when you're a flipper to handle your own accounting versus a wholesaler or a real estate agent or like a landlord. It's really easy usually. So any questions around that one?
No, I'm sure that you have some probably recommendations for people that are primarily doing flips. I'm sure we can get into at the end of like services, things like that, that you guys can help people out with that. Cause I do come across a lot of people and that are flip heavy. So maybe they do 70-80% of their business is flipping, maybe a little bit of sprinkle of wholesale to get cash flow up and running with, assigning some deals. So I'm sure that we can get into that later.
Yeah, for sure. Yeah, no worries there. Yeah, that's my biggest rule of thumb is that if you're a flipper or buying properties, just closing on them, you really need an accountant that knows what they're doing. I wouldn't try and run spreadsheets for your profit and losses and things like that. And I'm a huge fan of spreadsheets. I mean, I'm in spreadsheets 8 to 10 hours a day. But again, when it comes to inventory and flipping, I definitely would recommend an accountant so that you can use a software of some sort. All right, next one, rental properties, a couple topics here. So the biggest thing is, right, so we're coming up on tax time right here, right? The extension deadline. So in about 3 weeks, your business tax returns are due for your S corps and your partnerships. And then in about 7 weeks are your personal tax returns, where a lot of you will report your rental properties. And a quick note here is for rental properties, your accountant who's filing your tax returns are going to need a profit and loss per property, not per unit, per property. And so the reason is that's how they're reported on the tax return. They're specifically segregated out by property. And so a quick note here is if you want to screenshot this, or I can actually send you a template after that you can give to your audience, this is a perfect format to actually give your accountant because this mirrors the actual tax form where the information is going to be reported. So, but this is essentially the format of what you'd want to keep it in. So something with rental income up top, and then here are your expense categories here. One of the biggest things that we find with landlords is if they rehab the property, they'll put all of those costs. Let's say they did a new roof and they did some interior work, and let's say the cost came out to be 20 grand. they'll put those costs as repairs and maintenance and lump a big amount there. Anytime we see a large amount there, we likely assume that they've done some CapEx to the property. And you can see here that repairs and maintenance are typically small expenses for about $2,500 or less. If you have large improvements that you've done to a property, your accountant will love you if you just send them these three things in sort of just send them an Excel document with these three things. The in-service date of what you did. Let me go back. The cost of what it was, and a description. So for example, on June 1st, we spent 15 grand on flooring. Something like that is really going to help your accountant, because those don't get reported right here. Those get lumped into the depreciation expense because those larger items have to be depreciated. So again, if you send them a P&L that has this large number here, expect them to come back and ask you, hey, can you break this out and tell me what it was? And so again, a way to get a jump ahead would be to just send them a separate list of what those items were and just tell them this were right, like those were capital improvements. And then again, this format per property is what you can really help them out with. Even if you have like a fourplex, it's not going to be per unit. It would be for that entire property. So keep that in mind there for the rental side. Any questions? Anything I missed?
Would you just recommend, so let's say that you own 10 rentals. So you would recommend to make maybe a spreadsheet for each one with all of those costs broke down?
I literally have, so what I screenshotted this from is one Excel file, that left side where you see the rent received and all of the categories. And then I just have a separate column per property. So you can literally have one spreadsheet. And again, I'll send these templates to you so you can give them to them. Perfect. And I would just use that template there. And again, they would love you even more if you use this format, because this literally mirrors the tax return. So it makes the input so fast. They honestly might lower your tax bill. Right. Yeah. Some of your tax bill always has to do with how complex you write the documents you send over are. So if you're really clean with your documentation, you can save a lot of money.
That's awesome.
Yeah.
That's a really good tip. That's a huge tip right there, especially for, I know people sometimes are sporadic at the very end of the year, coming up to our extension deadline. So, hopefully some of these things might be able to, hone people in towards, find those last little dollars of write-offs.
Yeah. Yeah, for sure. Right. And like, I'll be brutally honest too. Like if we have clients that come to us and one of them's messy, one of them's not, the one that's messy is going to have a higher fee because there's more work on our team's end. So that's where anytime you can try to get your documentation in order and make it as clean as possible, the better for both of you, because you'll save money. They'll be happier. It's just going to be better all the way around. All right. So now we'll get into more of like a personal structure of entities and things like that. So this is a common structure for somebody that is doing their own self-employed business and then wants to buy rental properties on the side. If you don't have any rental properties on the side, totally fine. Just ignore this piece here. And this is likely the lane that you will run in right here. So you'll see we have three components: your individual self, you have the S Corp down here. The shapes mean something to us. We build these entity charts for our clients. So think of this rounded square as an S Corp. This circle is an individual. And then this trapezoid thing over here as just a disregarded entity. Disregarded entities to the IRS mean that they can just be reported really anywhere. They don't file a formal tax return on their own. S corporations file their own tax return. Individuals file their own tax return. So for example, which I even think I have in this next slide, I do. This entity right here, let's assume that this owns rentals. All I would do is, right, if I'm running my business here, let's say I'm wholesaling and flipping, I find some properties that I want to close on as rentals. I go out, I set up a separate LLC that I own personally. And all I do is I get an EIN number with the IRS and a bank account. The EIN and the LLC docs are what's going to allow you to get a bank account. They're going to require you get an EIN. When you get that EIN letter from the IRS's website, which again, those are very fast. Those should maybe take you 5-10 minutes. It's going to print out on there and it's going to say ABC LLC and it's going to say sole member. And that really just means you're disregarded. You can take that activity and report it directly to your personal return. Most of our clients, most of their rentals go directly to their personal return. So don't think that it's going to hurt you tax-wise to report those rentals on your personal return. It's not the case at all. And then, like I said here, let me go back. This is your S Corp. And so in this case right here, this person's going to file 2 tax returns. They're going to file the S corporation for their business. All of that income is going to flow through to them personally, right, on a K-1 because they're pass-through entities. And then they're going to file their rental activities here on their personal return as well. So just 2 returns, the S corporation and then their personal. Good note there that just rung a bell. I got this question the other day that if you run an S corporation and you don't take any money out of the business by the end of the year, are you still taxed on it? And that answer is yes. Whether you take the money out or not, you're still going to be taxed on it. And that's because these are pass-through entities. All of the income flows through to the partners or shareholders, and they pay the tax at the individual level. So again, very common structure here. You could have 30 of these little LLCs on the side. If you wanted to own your rental properties in separate LLCs, that's fine. What I tell people when to consider moving sort of or segregating their LLCs and putting rental properties in different, right, like different entities, really has to depend on the equity. So if I have $10 million of equity in one LLC and 2 million of it is in maybe in a bad area and subject to more risk, maybe I want to separate those out and put those in a separate LLC. That to me is more of a risk tolerance question. It's not a tax question at all because it's not going to hurt you or benefit you to separate them at all. So anything there?
No, I think the question that you brought up was a really good one. So that's a good question.
Yeah. So this is again very common, right? You have a business that you're running in, and then you just have, right, your separate LLC on the side. This is an example here of if you wanted to set up, right? So okay, like we'll use Ryan Pineda for example. He's got probably 7 LLCs that run within his wholesaling and flip operation, and really most of them are disregarded, right? They don't file separate tax returns on their own. And this is an example here of what I mean by that. So let's say somebody, they don't have rentals, but they've set up their ABC LLC consulting business, flipper, wholesaler, whatever the case is. And let's say you want to set up another entity to sell t-shirts, to maybe form an education arm of your business, but you want it to fall under the same umbrella. You totally can do that. In this case, you just have the LLC down here and it's owned by your S Corp. And at the end of the day, this right here is going to file one tax return. So this right here is going to have its own profit and loss. Let's say for how your education company did. This is going to be for your flip and wholesale company. And at the end of the day, your accountant will consolidate those numbers and file one tax return. And then again, you'll have a K1 from this S Corp here that flows to your personal. So again, you could have 30 LLCs here that flow through to your S Corp. Most of the time, self-employed individuals like I myself have one S Corp. And for example, my S Corp owns my interest in this firm. So even if I wanted to go out and do multiple ventures, they can be over here, and my S Corp will own my interest. So this is, again, a common structure for somebody looking to set up another LLC to do business as another company. So anything there? Anything I missed?
No, I mean, that's good stuff. I mean, I think a lot of people branch out and they like to do multiple things. I know real estate goes hand in hand with a lot of other businesses. So I think that's important information to make sure they highlight on is like, how do you structure this out at the end of the day?
Exactly. Right. And another question is, can I flip and do wholesales out of one LLC? Totally fine. That's very common. That's all fine to do. Again, when you want to start separating these things, or maybe because one of your lenders thinks that one entity is carrying too much debt and you need to set up a new LLC, maybe you want to separate the liability here somewhat. So again, there's a multitude of reasons, but most of the time you need that one S Corp as sort of your anchor, and then your other businesses will sort of branch off of that. Okay, quick partnership model here. So this will get a little complex here, but most of the time when people come to us and they're like, hey, I'm going to partner with somebody and do deals under a partnership, this is the model that we would recommend. So I'll touch on really the structure up first, but right, similar to the other one, these triangles mean partnerships to us. So you'll see person A, person B, they each have their own S corporations, and then each of their S corporations own their interest in that partnership where they're going to do deals together. Why would we recommend having these S corporations here? Here's why. Let's say person A goes out and buys a Range Rover to do business. They've been crushing it. If they write off that Range Rover under this AB LLC, the partnership, person B is going to share in that expense. And that's not the intent there. If I'm person A, I don't want to share my expense with person B. I want it all to myself to lower my income, right? Maybe that's a tax strategy that I have. And if I'm person B, I want that, but I didn't pay for that, So the reason we have these middle tier entities here are, one, not only so you can do business as yourself, again, education, because again, you could branch this off and have your own LLC here that's owned by this, but this allows you to do your own business and write off your own expenses. So a few of them here that I would always look for: vehicle, internet, travel, meals, right? Maybe person A wants to take a trip to Virginia and do business and scope new properties and meet with, right, like prospects and agents and brokers and write off some expenses related to that. If person B doesn't go, they don't want to share that expense with them, And so you don't want to write that off under the partnership. You want to write that off under your own S corporation. And so you will have expenses that occur here that are shared by both of you. Maybe you both go to a dinner, you both go on a trip to where you can write these off because you pay for it from the partnership. But again, we like to have this middle tier here so you can do your own business and write off your own expenses. And then again, that your S corporation owns your interest in that partnership where you're going to flip and do deals. So very common structure here for people that are doing deals for themselves and as we'll say partners. So partners, investors, things like that. So any complex there?
So
Yeah.
what if let's say that they have not 50-50 partnership, how does that split up? So let's say that you have like a lower percentage of ownership in the company. How does that kind of play out then?
So it would still run in this exact model. So really these two lines drawing to the partnership, that could be a 90-10, 60-40, 70-30, 99-1, whatever you want. So as far as the allocation of ownership, totally fine. It's just, I recommend having this S corporation here if you do business as yourself, because again, it gives you that second layer of writing stuff off. Because here's the example. Let's say this AB LLC made 200 grand net. And let's say it's 50-50, for example, 100 goes to each partner. Imagine I didn't have this square here and this line went straight to this person. Once they receive that K1, it's done. You can't write off anything else against it. You're done. That income is hitting you personally. You're going to pay tax on that. So that's where having that sort of stopgap right here so that you can write off your own health insurance, vehicles, anything really gives you that flexibility. So, but as to your question of allocations, the allocation of ownership can be whatever you want it to be. Obviously for a partnership just has to be some sort of split of, it'd be what, 99.99.01. But yeah, so allocation won't matter in this structure.
Cool.
Yeah. Yeah. Okay. Next one. So now we're going to get into some buzzwords that really start saving, right, some money as far as tax goes. Cost segregation being one of the biggest. And the first thing that I want to say with a cost segregation study is anybody can do them. So don't the question of can I do a cost seg study is always yes. It's more of should I do a cost seg study? And there's a lot of factors that go into that. What a cost segregation study does is really at the end of the day, it's a PDF report that you're going to be sent from a cost segregation study firm. You guys may be familiar with like Yona Weiss with Madison Spec, or we have a guy, David Weiner out of Georgia. There's a few of them that do that. There's DIYcostseg.com, which is another resource. You can do it yourself. All a cost segregation study does is break down the piece of property you just bought into buckets. And here's a quick example on the left side here. So let's say you buy a property, $525,000. This would be a common structure of how they would break that down. Let's say the land, we like to use, which I'll get into these percentages over here, the 30% and 20%. We like to be conservative to give clients somewhat of an accurate depiction of how this is going to save them money. So we've used 30% as a land allocation and 20% for bonus, right? And so I'll explain what that means. Of the $525,000 purchase price, we're going to assume 30% of that is land. That can be high in some places, that can be low in some places. For example, if I'm on a beachfront property, my land allocation is going to be much higher than a podunk Midwest Des Moines, Iowa property. If I buy something obviously, right, that's not on the ocean, my building allocation is going to be higher. And so here's an example of, let's say 30% is land. Let's say 294,000 is the building. And this right here is the real kicker. 5 and 7 year property are pieces of property like the paint, the flooring, the windows, the furnishings, the door handles, the doors, the desks, everything like that. When you buy a property, it likely will come with some of that. And if it doesn't come with actual furniture, again, it's going to come with these smaller assets like electrical work, fans, again, cabinetry, things like that. Why it's so important to find out the value of these assets is because that's what you can bonus depreciate. Bonus depreciate meaning I can take that as an expense in year one. So in this case, notice how the 525 ties to the 525 up here, and these are the buckets that we broke it down in. So here's quick back of the napkin math that if you wanted to run your own quick calculation to see what a property could save you, this is how you would do it. And this will come in handy because we have clients all the time where let's say they're going to net $1 million from their flip and wholesale operation. And now they're like, okay, how many rentals do I have to buy to pay 0 in tax? And this could essentially help you. This is how we would get to that. You would take the purchase price. You would multiply that times, let's say 30% to be conservative, unless you know the actual land allocation, which you could search through like your county assessor. You would find out what that land percentage is there. And then you'd be left with obviously 525 minus 157 is the building. Within the building, we like to find out what we can bonus depreciate, right, in year one, because you'll hear of 27 and a half year or 39 year. You don't want to take 367,000 over 27 and a half years. That's not going to be a large deduction. What you want to do is find out what you can bonus depreciate and take in year one. And a way to do that is we use 20% as, again, a fair, conservative estimate. If anybody's running around out there telling you 50% of the value of the building, complete lie. You would get hosed at the end of the year doing that. So what we would do is we take 20% times 367 gives us to a $73,500 deduction. And all that means is that's an expense against my rental income. So if we go back here to this example, you'll see that I even broke it down here and have that same number. Let's say an average rental property brings you 33 grand of income. You have some insurance expense, some management fees, mortgage interest, repairs and maintenance. And then boom, you come in with this whopper of a depreciation expense. It gets you to a huge net loss. And the point of that net loss is if you follow certain rules, you can net that loss with your flip and active income. And that's like the Mac Daddy strategy. That's where 99% of our clients want to get to, because that's what you see with like the Robert Kiyosaki's, Donald Trump, and all these big guys who are doing big deals, Grant Cardone, and they're netting it against their, again, flip income, educational income, and all of that. So that right there is really the nuts and bolts of a cost seg study. This right here is your back of the napkin. Hey, what can this property give me as far as a depreciation expense? Anything there? And that's a lot to take in. So, I mean,
I'm curious of how many people come to you, like whenever people come to you originally, like have this detailed of information like in their business, like what's the percentage that has any of all of the stuff that you're talking about here, even just cost seg? Like who knows this information whenever they're coming to you? They kind of have an idea of it or just not maximizing it, or?
Oh, they have an idea. They're not maximizing it at all. That's the whole reason that we're coming into play, is because and like the scariest part is, to kind of get candid, is, dude, a tax return is a report card. So at the end of the day, you can put whatever you want. Your tax preparer can put whatever they want, but are you following the right rules to where you can use these to your advantage? So like I said, the Mac Daddy strategy is taking this big depreciable loss right here that you see on this property. And let's say I made 100,000 as a flipper. Now on paper, if I could net these, I made 43 grand. That's a huge tax savings. So most of our clients now are right versed in this and understand it. But the clients that come to us, they've only really heard these topics and they don't really know the nuts and bolts of it. And so, which again, we'll get into too, like of really my comments of how I would look for a good tax advisor, but finding somebody that works within your industry, because as you can see, like if you don't really know how this stuff works, one, it can get you into a lot of trouble if your tax return looks messy and you're trying to do this, and then you get flagged for audit and then you don't pass and then you pay all these penalties and fines. But if you do know it, I mean, like one of our best success stories this year was we had a guy net a little under $1 million, like 980,000, and paid zero in tax. And like, that's just a clean example of, I mean, he's making $1 million. That's a good amount of income. And again, like through these strategies and his own portfolio and syndicates, paid $0 in federal tax, right? He had payroll taxes and things like that. But, but we have someone else who's netting 600,000-700,000 and they're paying $250,000. So you really start to see the differences between people who are versed in it and have these strategies available to them versus people who just maybe hear stuff on TikTok and they want to apply it. But you really need an advisor to help you when you get to this level. The TikTokers I enjoyed, but then sometimes I watch them and I'm like, man, I just wish I could like reach through the screen and punch that person. It is what it is. So
the influence, man.
I know. But, and again, sometimes they're good because you're like, but you're just leaving out so many details that like these people need to know. So, And that's where some of this stuff can get boring, but like, this is where the money's made is saving it right on the tax. So, all right, but that's cost seg. So basically at the end of the day, what I'll leave you with there is, at the end of the day, you can get a cost seg. It's likely that if the property is at least 250,000 plus, I would get one. They're just going to send you a report. And really, you should let your accountant take it from there as far as breaking it out on your tax return and taking that loss. That's stuff that they'll get into. So, all right, next, here's sort of a sleeper that a lot of people forget, but this is called partial asset disposition, and we'll go over what that is. So partial asset disposition is, let's say that I put a new roof on to a rental property that I own. And in this case, let's say it's 10 grand. When you dispose of an old asset like a roof, there's a loss there that you can recognize on your tax return. Most people and most old, we'll just call them Joe Schmo accountants, leave them off of the tax return, and they don't help you in this case, which is disposing of the asset to give you the loss. And here's the math of how this works. Let's say that I had a roof that initially cost me $10,000. Okay. Let's say I've depreciated that roof 4,000 worth so far over the series of time. I'm left with a net book value of $6,000. So notice how my cost minus my accumulated depreciation, what I've depreciated so far of that asset, I'm left with 6,000. Next, if I dispose of it, I'm not selling it to anybody. I'm simply scrapping it and throwing it away. So my proceeds there are zero. My cost or my net book value is 6,000. So I have a $6,000 loss on that asset. And again, most accountants will just scrap it versus if you dispose of it on the tax return, therefore I just got a $6,000 loss, and it's likely on my new roof that I just put on, I can depreciate that as well. So keep that in mind that if you have rental properties and you're disposing of AC units or any asset related to the property, talk with your accountant about doing a disposition because it could really save you in some tax. So again, this is around, the buzzword would be for you and your accountant. If you dispose of any assets on your rental properties, make sure you're asking them, hey, can I dispose of this and will it help me through, right, like a partial asset disposition? So keep that in mind there. Okay, I was going to say next should be recapture. So while we're on the topic of net book value, it's very important because this is a great example that we get a lot. We'll have people come to us and say, hey, I bought a car for $80,000. And let's say they bonus depreciated in year one. They use it within their business and they got this huge $80,000 expense. In year two, they'll sell it for 50 grand and think, oh, cool, I got a loss of 30 grand. I bought it for 80. I sold it for 50. I lost, right? I have a loss. That's not the case at all. Here's how the math works on that. As far as depreciation recapture is basically the government saying, hey, we gave you that big depreciation expense. Now you got to pay some of it back through a gain, right? If you took an expense in one year, you're going to have a gain in the next. And here's the math of how it works. Depreciation recapture. Purchase price, let's say you buy this vehicle for 80 grand. It's a Range Rover. It's more than 6,000 pounds. You use it 100% for business. You haul materials. You do showings, whatever the case is. You bonus depreciate the entire thing. That's a pretty big savings, right? $80,000 deduction right there. Your net book value is zero, right? Back to this example. Your net book value is cost minus your accumulated depreciation equals net book value is zero. If you sell it now for 50,000, what's the gain calculation? Proceed, which would be 50 minus net book value equals gain or loss. So if I sell it for 50, my net book value is zero, my gain is 50. So I technically have to pay recapture on 50,000. Recapture just means think of there's going to be an additional 50,000 included as income in that case. And two things there. You still work, right? So then one of the questions would be, well, should I even take depreciation? Yes, you should, because time value of money would tell you always take the expense now. And in this case, you still got a surplus. You took an $80,000 deduction and only had to recognize $50,000 of gain the next year. The way to combat this is look at Grant Cardone. He goes out and buys an $80 million jet, depreciates it in that year, sells it the next year, probably has a massive gain. And then what does he do? He goes out and buys another jet. So it's, yes, you could say it's sort of a recurring model, but again, as far as the tax savings, it's still huge because these are big expenses that you're able to bonus depreciate in year one. So vehicles, jets, small planes, heavy equipment, big rehabs to properties, all of those things. So don't think that recapture is a reason to avoid depreciation. You always want to take depreciation, but you just want to mitigate it again through tax planning. So any questions there or anything maybe else I could touch on with that one?
No, I mean, I think that's a big hitter right there. So we see that a lot, right?
Yeah, cars are big.
Yep.
Yeah, cars are big ones. So G-Wagons, Range Rovers, even the EVs now, right? Like I think the Porsche Taycan. So if it's over 6,000 pounds, that's what's going to give you the benefit there.
Yeah, that's huge.
All right, this right now has to be the biggest strategy out there. And this is a quick and dirty of, this will be a lot. Overall, the IRS classifies rental income as passive. The money you make as a flipper or wholesaler is non-passive. there's very strict rules to net those losses together. And when I say net those losses, if we go back here, the loss you saw from this rental right here of 57,000, you would have to pass certain rules to be able to net that against your active income. A quick loophole to this right now is the Airbnb loophole. And so here are just some main talking points on this. If you can get a property where the average rental period is 7 days or less, you avoid being classified as a rental activity by the IRS. That's huge. You're not held to those strict rules. So if you can do that, the next step to that is you have to materially participate in this property. And this is where everybody's like, oh, well, I have to manage it. Yes, you do. But think about it this way. Maybe you buy it late in the year and only manage it for a couple months. That's a way to do it. Or at the end of the day, you suck it up and manage it, but then you get this huge tax savings. And then on year 2, you hire a manager and let it go on autopilot. Because all you did was in year 1, you got a cost segregation study done on it. You suck the depreciation out of it in year 1. You got this big loss, netted it against your other income. And then in year 2, you let it ride. You hire a property manager. So in addition to having the rental period be 7 days or less, you need to materially participate. And this is what all the TikTokers and the Instagrammers forget. There's 3 core ways to materially participate in a property. The first one is 500 hours. And I can tell you one rental property is likely not going to get you there with 500 hours. So unless you're doing a ton of rehab, it's a short-term rental, obviously, where you're managing bookings and doing all of that. You likely won't hit 500 hours. So the next most realistic one is 100 hours and no less than anybody else. And then the third one is substantially all, which is you're telling the IRS, hey, no one else worked on this property. I worked on the property. It maybe only cost, or it only took me like 60 hours. But again, I did all the work. You can see that the theme here is that the IRS wants you to have skin in the game. If you're going to take these big losses from real estate and net them against your ordinary income, they don't want it to look like you just bought these properties, sat back and took these, right, and just collected a check and you're taking these big losses. They want you to be involved in the day-to-day. And so another quick tip there is if you hire a property manager, it's likely going to kill the deal for you as far as getting the loss. Because if you were flagged for audit and it goes right, and let's say you go to tax court or you're even talking with an auditor, there's no way you would pass and say that you materially participate with a property manager. You need to be doing most of the work yourself. So back to this case here of the 100 hours and no less than anybody else, that's likely going to be the case that you would fall in, because with a short-term rental, you're going to want to hire cleaners. You're not going to want to do that piece yourself. And so you're going to have to hit at least 100 hours through, here's some hours that count: screening the tenants, listing it on Airbnb, handling bookings, advertising, doing the books for it, or some sort of record keeping, right? Collecting payment, things like that, staging, decorating, rehabbing, dealing with HOA. There's a laundry list of things. And so overall, at the end of the day, if you hit 100 hours, and let's say your cleaners only took 70, 80, 90, 100, 110, but you're still above them, it can work. And so if you can buy a property, average period 7 days or less, you materially participate. And then the whole goal there is you get a cost segregation study, which is going to give you, we'll go back to this property here. Let's say this is the exact math. You got 33,000 in bookings. You paid some insurance, some management fees, mortgage interest, repairs. Boom, this big depreciation expense, which again came from this math here. Where was that? Right here. Doing the cost segregation. The whole point is now you take this loss, 57,000, and net it against your ordinary income, which, like I said, that's the Mac Daddy of strategies. The alternative to that, because some of you may be saying, well, wait, what if I want to do this with my long-term portfolio? I don't have short terms. That's where you got to be a real estate professional. You got to materially participate. There's grouping elections there. And so, I mean, honestly, if we wanted to come back, and we can do an entire talk on that side of things, but that is where this gets so intricate, is because, one, I'll say this is the most heavily litigated tax code section there is. It's been the most litigated in tax court. Some of the court cases are almost laughable, because you have people, for example, when it comes to tracking your hours, the tax court will look at an hour log. If you're flagged for audit, the IRS will ask for your hour log. So for example, a good sign of a good CPA, they'll give you an hour log template, right? We have ones that we give to our clients. And so they've actually found, for example, that one guy tried to charge 40 hours to changing one toilet. They threw that out. They've had somebody where they caught a guy that was saying he spent hours on a property, but was actually out of the country. because they were able to tie that back to credit card statements. So you can see that this is a tax code section that you really don't want to play with because of how powerful it is. Case in point of the Donald Trump's, Kiyosaki, our one client getting $1 million in net, but paying no tax. So you want to make sure that you're complete bulletproof when it comes to taking these strategies and that your documentation adds up. So that was a long one. Any questions there? Anything else I can maybe touch on? But that's a lot to take in.
Yeah, I guess maybe some questions that would pop up, like those hours. What would be classified as those hours? Like, how would you recommend people logging those hours? How do you, let's say that you go the easiest route, which is obviously the 100 hours, no less than anybody else. Like, how would you recommend? Like, let's say that you had cleaners in there, you had somebody redoing floors. Like, how would you manage all that, and where would you house all those things?
So you bring up a really good point, is if, because you're going to hire other people, you have to track their hours, and that can be tough. But at the end of the day, honestly, an Excel log with a date, amount of hours, and a description is going to be the best. And at the end of the day, that's what the auditor would ask for, right? They would ask for your time log. So that's where it's going to be hard if you're doing a complete rehab and not doing some of the work yourself, because at the end of the day, you have to look at your cleaners, your contractors, everybody. And if you're going to try to pass this, maybe if the project is big enough, we have a client now up in Sedona. They bought a $2 million property, and they're going to do most of the work themselves as far as staging it and things like that. And this property is so large, they might hit the 500 hours because it's so big and there's so much involvement. But on a smaller scale, you have to make sure that you're hitting at least 100 hours and you are tracking other people's time. And like I said, it would really just be through an Excel file, which the hours that count, you bring up a really good topic there too. If the IRS looks at your time log and they see that most of your hours are investor hours or education and research hours, they'll throw that out too. So if most of your time log says, I was on Zillow for 2 hours scouring deals, or I was calling people, or I was running pro formas on properties, to them, that's investor level and research hours. You're not really, notice how those hours won't really affect that specific property. They want to know that the hours and the time you spent on the property is going to have an effect on it. Basically, that without the time you spent on it, it wouldn't have been able to run. And that's where we always get the question, well, can I hire property management? And it's 99% of the time going to be no, because then at that point, they're running it all. They're doing it all. They're going to spend more time with you or more than you. And the hours you spend, if you have a property manager, aren't going to be material to the project. They're going to be investor level hours. So
That makes sense.
yeah, but I would just say an Excel file at the end of the day, date, how many hours, and description is like really will suffice. So
Yeah, that's good.
Yeah,
I know that everybody's scared of the auditors, right? So whatever they can do to be armed in case that is the worst case, I think that's a key takeaway.
Yep, exactly. Right. And like quick note on that too, I can tell you, if you're going to be audited and you're selected for audit and you took strategies like this, you're going to want a CPA in your corner. You're not going to want to try to go at this yourself, because at the end of the day, your CPA could write a quick letter, have one phone call with the auditor, and off they go. Right. Versus them coming and poking around, and then they see you did something weird, and then now they open the audit up to years prior. And so it can become a mess. Yeah. So yeah. So right there though, in total, that's like probably the biggest strategy out right now. Some of the other CPAs in the space, my guess is the IRS is going to somewhat catch wind of this and try to make adjustments to this so people can't do this, because notice how rental activities are passive. This is simply what you've done to avoid this, is just simply having a property where your average period is 7 days or less. And then by then you avoid the definition of it being a rental. And so that's really what allows you to do this strategy. And again, my guess is the IRS is going to try to stronghold this and change it. So I would take advantage of this definitely while you could. Some quick strategies to save and just some expenses that I think are just really overlooked. Home office is a good one. I mean, I'm sitting in a home office and this is where I do the majority of my work, and I got cameras, I got lights, computers, desks, furnishings, things like that. So make sure that you're taking all of that as an expense. Cell phone's a sleeper. The equipment, computer, speakers, any equipment you buy for your business, make sure that you're writing that off, especially now if you're transitioning to doing more educational and content. Meals, this is a huge one. I personally love to do dinner with clients or write prospects and things like that. And meals now are 100% deductible. That shook the tax community when that came out, just because it used to be 50%.
Yep.
So you'd have somebody spending 10 grand a year in meals and they would only get 5,000. Now, because of COVID and the restaurant industry getting hit so hard, they've bumped that up to 100. So that's huge. I would take max advantage of that. Education's a big one. So people that are paying for masterminds, for courses, anything like that definitely is deductible. We get a lot of questions as to whether that is or not. That 100% is. And then vehicle again is another sleeper. You don't need to buy the vehicle that year. The vehicle does not need to be in the business's name. It can be in your personal name for you to take the deduction. The biggest tip there is just make sure that you're tracking mileage. What do I mean by that? Track your business mileage versus your personal mileage. That is going to tell you what percentage of the vehicle is business use. So in the example a few minutes back of the Range Rover at 80 grand, that's assuming that person used that vehicle 100% of the time for business. So what would be likely is maybe they have a personal vehicle they use outside of using that Range Rover. So, but if you have a vehicle where you're doing 95% of it for business and just 5% groceries and whatever personal use, I would still take 95% of that vehicle as an expense. If it's greater than 6,000 pounds, then you potentially get into that bonus territory, which is awesome as well. So keep in mind there for vehicles, try to track your business mileage. I recommend using the app Mile IQ. That's what I found to be the easiest. That's as far as feedback, what we get as far as what helps. So, but yeah, these are just some sleeper strategies here that can easily save you a few thousand, if not way more. So keep in mind of those. Strategies to defer income. So these are, again, I would just say some sleepers that people don't think of. They'll look at a property that they have. Maybe they have a portfolio of 10 to 15 properties and they think, oh, I got to sell one, right? Because I need some cash now for another deal. Cash out refinance is huge. Maybe not the best right now with rates going up because debt is getting more expensive, but cash out refis are big. Basically, right? If you have a ton of equity in a property, you pull out cash through refinancing the debt. All you've done there is you've got tax-free cash. Your interest, right, has obviously gone up. So that's a bigger expense to you now on the property. But at the end of the day, you didn't have to sell the deal. So I'm always a fan of never selling. I'll never forget. I was young and I saw this sick Mercedes pull out of this really rich neighborhood and his license plate said never sell. And I was just like, man, that struck me as like, it's so true. Anytime I've sold a rental property in the past, I've regretted it versus looking at the values now. So just always keep that in mind that you can do a cash out refi and get access to that cash to do other deals. You can use that cash for whatever you want and it'll still work and you hold on to the property still. 1031 exchanges are big too. Maybe you're ready to now move up into a bigger property, maybe some multifamily or a bigger unit complex. So 1031 exchanges are great, but two things that I want you to keep in mind with the 1031 exchanges, and actually three. One, you have to go through an intermediary. Don't think that if you follow these rules but don't use an intermediary, it works. You have to use a qualified intermediary who's going to handle the cash for you and put it into, they're going to take it from the current deal, put it into the new one, sort of like an escrow company. But you have 45 days from the sale of that property to identify your new property. Okay. And then you have to let that intermediary know because it's literally going to say on the documentation that we get, your accountant, the identification date. And also you have 180 days to close on that new property from when you sold the other one. Keep in mind that these dates or these time periods run concurrently. It's not 45 days, then 180. They run at the same time. So those are two deadlines that you have to stick to or you lose the 1031 exchange treatment overall. So not a bad idea that if you're considering selling a property and 1031ing it to try and find what that property is up front. So the last one being generate passive losses to offset when you sell later. Quick example. If I go back to this example of the rental property here, where let's say this is year one, you have this property, you did a cost segregation study, big depreciation expense, you got a big loss. Let's say this was a long-term rental and you hire a property manager. Totally fine. You now have a big $57,000 loss that is going to be suspended and carried forward, meaning you can't net it against your ordinary income from flipping, wholesaling, and things like that. Most people think, well, if I can't net the two, that sucks. That's bad. Not the case. Because you can carry it forward, if you end up selling that property at a gain, you can take that loss against the gain. So for example, if let's say after year one, I sell this property for $40,000 profit, I technically have a loss here still. I wouldn't pay any tax on that profit because of the loss that I drove from the activity and getting a cost seg study. So that's why I'm always a fan of still getting the cost seg study, because even if you can't use this loss in year one against your like day-to-day income, you'll be able to recognize it later and use it later. So always keep that in mind. All right. So again, quick ways to defer income, get access to cash, cash out refinance, huge. 1031 exchange, big. Make sure that you keep in mind these dates though, and you use an intermediary. I think one of the ones that we see most frequently is called IPX exchange. Pretty cheap. I think they charge $500 to $1,500 to facilitate the transaction. And then last, generate passive losses. So again, this goes back to make sure you're getting those cost seg studies and accounting for every transaction. Just some my personal thoughts. If we were at a bar together, what I would tell you to look for in a CPA, two things really. Know the industry, obviously. So many of our clients that come to us, they feel that they've just outgrown their current CPA. Their CPA, they're going to their CPA and they're like, hey, I read this online. I saw this on TikTok. Like, is this relevant to me? And their accountant is like, yeah. And then they're like, well, damn, why didn't you tell me about that? And I can tell you that one of the biggest reasons is they don't do personalized planning. Most CPAs right now, even when we first started, we were just, hey, come to us. We'll prepare your tax returns. Your fee is $3,000. We'll prepare your tax returns. It didn't include active planning. And that's where when you're finding a CPA to work with, you want to ask if they do actual tax planning. And that's because that's where you sit down, look at everything entirely, go over your goals, where you're headed, what your business is projected to do. Do you want to go the retirement route of like the 401k? Do you want to buy rental property, short-term rentals? And you account for all of this in a tax plan of how you can bring down your tax bill. And that's exactly what we do. And that's what I would recommend, that if you're somebody in the real estate space that wants to save money, you do that. You find somebody that's going to give you that level of service. And so those are my two sort of main pointers that I would look for is, are they in my industry? Do they service people that are similar to my business? And do they do personal planning? Personal planning is where you're going to save all the money. And then I think I had, yes. So to leave with, every talk that I do at a presentation, at an event, whatever, it always comes back to bookkeeping. And this is where I can say, without the boring bookkeeping, the bean counting, the QuickBooks, the spreadsheets, you can't do any of that fun tax planning stuff. And that's where we even now have clients that they've come in, they make a good amount of money, they're running a business, they want to start tax planning, but we can't because we don't have their books in order. They don't have their books in order. So what does this turn to? We come to them and we say, hey, we do accounting too. Like, we can help you here, but all we know, whether you go with us or you go with someone else, it has to be done before you do tax planning. So that's where tax is fun. That's where you're going to save a lot of your money and be able to do more deals because of the tax savings. But again, you can't do any of that without good bookkeeping. So as a, again, word of advice, if bookkeeping is going to cost you $500 to $2,000, $3,000, $4,000 a month, which some clients do, we have some clients where we're upwards of $8,000, $9,000 a month because their business is at that scale. It's going to make sense to get that because it's the backbone to everything. And so, right, again, I really just can't stress that enough, right? Where I talked to one guy the other day, I almost fell out of my chair. He was making $300,000 or $400,000, and he had asked me if he thought it was worth it to pay the $25 a month for QuickBooks. And I was like, I almost lost it. I was like, yeah, of course. Like, because you have to think about it too. For a business to go out and hire a staff accountant, it's going to run them $45,000 to $70,000, depending on how good they are. So you have to think about it as, if you find somebody at $1,000 a month to do your bookkeeping, that's only $12,000 a year. And they're basically acting as a staff accountant. And like I said, we have clients where come tax time, we're waiting on them to compile things and their books aren't ready, versus some other people, they have QuickBooks. We go into QuickBooks, print their profit and loss. They're done. We do their tax work. It's over. So you're going to save so much money in the long run, keeping your books in order and actually tax planning, than if you just try to bum rush last minute, and especially do it after the year's over. So to get on, right, the second bullet point is tax planning occurs throughout the year. That was one of the hardest things for us as a firm to charge for, was because it's like, how do you charge for a relationship? Because you want to be there when the client has a new situation. And so we found a way to do that. But that point is to really hit on, you have to communicate with your CPA throughout the year. This isn't a call me come March or April, file the tax return and be done. We have to plan for your taxes throughout the year. And really coming up on Q4 right now is heavy tax planning season. This is where you should know what your numbers are year to date, so we can project what your tax bill is. And then from there, let's say I come to you on Monday, we have a meeting, we go over tax planning, and I tell you, hey, your tax bill is looking like it's going to be 80 grand. And you're like, yeah, I don't like that. Well, then we got to strategize on how we get that down. And so those are really the two things that I'll leave with is bookkeeping is, again, the backbone to everything. And tax planning has to occur throughout the year. So back to this, how I would find a solid CPA, somebody you can be personable with, and one that's going to be honest with you and plan throughout the year with you. So that's the biggest thing. And like last thing is the last event I spoke at, it was a room of 90 people who were the higher level participants of the group. 90 people. I had posed the question of, if we met next Monday, could you have your books in order and be ready to tax plan? 4 people raised their hand. So that was insane for me to look at. Is like, there's a ton of people making money, but you're leaving so much money on the table through not having your books in order and not doing proper tax planning. So again, I just can't stress that enough, that bookkeeping is really it's the most boring, and there's a lot of work behind it, but it's the backbone to everything. So yeah.
Yeah, it's huge, man. Really quick, I do want to kick it over. I had 2 questions in the comments from Chris Rojas. He said, are you able to write off an ATV, boat, or RV, and also a vehicle over 6,000 pounds? If so, do we buy these items under personal name, or do we pay from out of our business account?
So yes, you can write those off if they have a business use, right? Like if they have a business purpose. So for example, you rent ATVs, maybe you're doing Airbnbs in sort of a forest cabin area, and you need that to roam around to your Airbnbs, whatever the case is, if it has a business use, yes, you can write that off. And yes, if it's over 6,000 pounds, it's eligible for bonus. And you do not need to buy it in the business name. So don't let that hold you up of whether you purchase it or not, or whether you write it off or not. We have a lot of people that are like, hey, I didn't write off my car because it's not in my business. And we're just like, what are you doing here? So yeah.
All right, cool. Then that's good. His second question is, what happens if we close on a deal under his rental LLC with the hopes of keeping it as a rental, but then decides that he wants to sell it instead? Should we deed the property back to our flip company before selling it?
Nope. To be honest, you should do it outside of the flip company, because there's a chance that you can treat it as long-term or short-term capital gain instead of ordinary income. Ordinary income is, I buy a flip, I rehab it, I sell it. I pay federal income tax and I pay self-employment tax, right? That 15%. If I have a capital asset like a stock or a rental property that I'm holding for just investment purposes, it's not subject to that 15%. So I would not deed it back. I would leave it in that same LLC and just sell it from there. And then your accountant will know what to do, assuming they know what to do. You know what I mean there?
Yeah. Cool, man. All right. So I guess the question that I have for you, man, let's say that somebody, watching this right now, they have a, the old school CPA, and they're not really happy with their services. How could somebody reach out to you, your company? Let's say they were interested in, hopping on like maybe a discovery call or something like that. How could they reach out to you guys? How could they get in contact?
Yeah. So we'll give you guys a specific link that you can share. So it'd be that through the, that link, our website, and that contact form. Or honestly, if you see me on Instagram, you can DM me on Instagram, and then I can link you with Nick. Nick from our team is who you'll speak with. Again, run through services, how we can work together, what our structure is. But really, those are the 3: website, that special link for you guys, or just, I'd say, Instagram. And my handle is just my full name, Matt Bontrager. And I post tax tips and stuff there too. So I try to give good context to it. But yeah, that'd be the best way for sure.
Perfect, man. Well, awesome. I think you dropped some bombs on us today, man. I know that, commonly like the number one thing that I see is that people do wait till the end of the year, man, that, they gather the books and it's like fire sale for a whole month. And the business takes that little bit of a dip down because they're spending so much time trying to maximize on these things. So, I think with the things of what you spoke about today, how to really keep those things, tight knit. I think that's really important, and it's really a huge value add for, everybody that's tuning in, and everybody that's, going to watch this recording. So I appreciate it, man.
Yeah, for sure. Yeah. Anytime. Cool.
All right, man. Well, I appreciate you hopping on and taking the time to drop us with all the knowledge today, man. And look forward to seeing you on here in the near future.
Perfect. Let's do it.
All right, man. Take it easy.
Appreciate it.
All right, guys. So if anybody's interested in reaching out to him, I'm going to go ahead and drop whenever this link goes live. I'll go ahead and put the link in the comments if you guys want to reach out to Matt. and, set up a discovery call with them. So I appreciate everybody hopping on. And once again, thanks for tuning in, and we'll see you guys on the next live. Have a good day.